Okay, welcome to Stock Talk with Nico Kritikos. Today we're going to be going through stock market investing for beginners 2022, and I'm going to take you through everything you need to know. So the stock market is a place where people exchange shares of a company, and a share is just part ownership of a company. So when a company decides to go public, they choose either to go public on the New York Stock Exchange or the NASDAQ, or there's other ones, but those are the two most popular. And then what happens is the share price of a stock is determined by the valuation of a company as well as how many shares are going to be issued. So picture that a company is worth $1 million and they decide to issue 1 million shares. Then that means each share is going to be worth $1. And that's the way you get to that market cap. And that is what the company is valued at. Then you have investors like retail investors, and you have big funds like hedge funds and stuff. They invest money into these companies, and that's how the stock price gets pushed up. And then if the company, if we or the hedge funds sell out of these stocks, that's how you get stocks to fall. And it's pretty much just like simple supply and demand, where if you have high demand for something, then the price is going to go up. And if you have too much supply of a product, but not enough demand, then the price is going to come down. And that's exactly how it works with the stock market. So then what you're going to do is you're going to have to find an app, like a brokerage app, such as Robinhood, Fidelity, or E-Trade. And you're going to make an account on there, and you're going to probably deposit a small amount of money, something you're safe, you feel safe with investing with right off the bat. Personally, I use Robinhood as my favorite. I also have a Fidelity account, but I do kind of like the way Robinhood works a little bit better. So I would probably recommend that one, but really any of them are fine. And then the next thing you can do is you can invest in an index fund. And an index fund is just pretty much a collection of stocks. So the popular ones are SPY, which is the S&P 500, as well as the NASDAQ. And so SPY is a collection of 500 of the largest companies in the United States, okay? Or like the NASDAQ we can see here consists of Apple, Microsoft, Amazon, Facebook, NVIDIA, Tesla, Google, Adobe. And in these index funds, the bigger the company is, so Apple is the biggest company in the world, they're going to get 11.5% weight. And so that's how these things are distributed. So what you're doing is if you go on, let's say we go on Robinhood and we decide to buy one share of SPY, or let's say we decide to buy a share of NASDAQ, then what you're doing is you're pretty much having your money, you're owning a tiny little fraction of all those companies we just went through. Okay. So you can see here the NASDAQ in the past year has gone up 57%, but on average, it's going to go up about 10% a year, which is what I have here. And so in this, we can see here with compound investing, if you started out with $1,000 and you contributed $500 a month for 10 years at a 10% interest rate, you will have $98,000 in 10 years. And that's with investing $6,000 a year. So it'd be $6,000 a year plus the initial $1,000. That would be $61,000 you invested in total during those 10 years, but you would end up with $98,000. So that's the power of compound investing at a very conservative and simple way. So if there's one thing I want you to take away from this video, it's that you need to decide whether you want to do passive investing or active investing. So passive investing means you're not really putting in much work or much time. You're just buying those index funds, and you're going to average 10% a year, and your money's going to grow and you're going to be fine. Okay. However, if you would like to put in more work and more time and potentially get some, big gaining stocks, then you could do active investing, and you can pick your own stock. So instead of buying those index funds, you could go up here and buy a share of Apple or a share of Amazon, and then you can own an entire share, and it gives you more flexibility. But sometimes it is riskier to do that, but if you are committed to this, you can end up with double or triple the amount of gains that the regular market's going to get you. Now, the next thing is weighing risk and reward. And this is very important. This is something you're going to need to know every single time you invest in a company, because the two ways to measure this is not only through the company's success and how safe they are as a company, but also what type of valuation is the stock trading at? So when we say is buying this stock risky, there's two ways to look at it. Is the company risky or is the valuation risky? So let's say we have a really strong company, like let's say we have Apple, okay, but let's say the valuation on the stock is sky high. Let's say it's trading at way higher than it should be. Well, then that's kind of that's a riskier investment, because there's a good chance that stock's going to come back down to more normal valuations. But let's say on the other hand, we have a company that is a newer company. Maybe they haven't made a profit yet. They're still growing, but let's say the valuation is very cheap. Let's say you're paying, a very small amount for huge potential in the future. And so that could be considered not a risky investment even though that company is a million times more risky than a company like Apple. So two things you have to consider when you're buying into these stocks, but the main thing is to decide, do you want to do passive investing and make 10% a year without doing any work? You're going to go with the index funds. If you want to put in more work and you want to try to make some more money, then that's where you do active investing, and you're going to pick your own stocks. And then that's where we get to different types of strategies. So these are just some main popular strategies. We have value investing, growth investing, dividend investing. There's long-term strategies, short-term strategies, and then there's also different diversification methods and different ways you can use all these and mix them. So value is pretty much that's like the traditional, like a Warren Buffett style approach, where you're picking safe, strong businesses and you're trying to buy them at cheap valuation. So that's like Warren Buffett buys, he's big on Coca-Cola. He's big on Bank of America. He's big on Apple, companies that are very safe and strong. And then you try to buy them at a cheap valuation. Then you also have growth investing, or a growth strategy, which is where you're buying riskier growth companies, and they normally trade at more expensive valuations, because the more growth the company has, or the more potential they have, then the more expensive the valuation is going to be, and the riskier the investment is, because there's potential to have a bigger return. So that's growth investing. Dividend investing is similar to value investing, but this is where you're looking for stocks that have a safe dividend to them. The average dividend is probably somewhere around 2%, maybe 3%. You can find some that are, upwards of 7% or 8%, especially like in the REIT industry, the real estate investment trust stocks. Those a lot of times are higher. And there's also stocks that pay monthly dividends, quarterly payments. And then the main things you want to look for when you're looking at these dividend stocks is the payout ratio. And you can find this on a bunch of different websites, but the payout ratio of a stock is going to be what percent of their earnings is going out in dividends. So in other words, let's say a company makes $5 and they pay all $5 out in dividends, then they have 100% payout ratio, because they're paying out 100% of their income in dividends. So you kind of want a low payout ratio. A lot of times, if you can get it like under 50%, that's normally a little bit safer. And the other things too are you want to have a strong balance sheet with lots of cash, more assets than liabilities, as well as strong cash flow. And then we have long-term investing, which is really like normally it's 3-year, 5-year, 7-year approach. And then you have short-term investing, which is like a day trading type of thing, or a swing trading, where you're kind of betting on short-term movements, whether it's through the day or through the week. That's normally a little bit riskier. A lot of the the richest people in the world, the Warren Buffetts, the Elon Musk, they do the longer term strategy. And then finally, you have diversification. This just means you can mix all these. That's normally what I do. Is I have you want to have a mix of them. The other thing too is you kind of want to see in the market at that specific time, where is the money flowing in and out of, and which a lot of times like one or two of these categories will be overvalued, and then that's where your opportunity is in the opposite one. So like right now in the stock market, the growth stocks are beaten down a lot, and then the value stocks, the safer stocks, those are trading pretty high. Those the past couple of months has been pretty strong for them. So that in a situation like this, you would want to invest in the these growth companies, or a lot of times they're smaller cap companies. Finally, we have the research you're going to want to do. One thing you can do is look at Nico stock market checklist, which I have right here. And this is in almost all the videos I make. These are all the things I think you need to look for in a stock. I pretty much have compiled this over the last couple of years. These are just all the important things. And then on my Instagram here, I posted something here that says principles. And this is a little bit different. These are more like, so number one is don't sell too early. We also have, buy your stocks in pieces instead of all at once. Buy the dip if it's over, if it fell over 10%. Be careful about, if you're buying into a company, make sure it's fallen a little bit before you buy in. And then number 5 is don't time the market, and just stuff like that. So those are 2 resources. Another one is podcasts. There's lots of podcasts I listen to. One is my podcast, Stock Talk with Josh Beaudry and Nico Critico. So you can check that one out on Apple Podcasts or Spotify. And then you have, directly from the company, like SEC filings, 10K, 10Q. You have earnings calls. You have investor presentations. You have newsletters. I watch lots of YouTube videos to get lots of information from that. You have Seeking Alpha, where you can read lots of different articles and look at different valuations. You have Yahoo Finance. That's this. This is one of the most common ones I use. I pretty much am on here every single day. And this is where it gives you pretty much all the statistics you need. The only thing you got to be careful of is making sure the numbers are updated. So like, especially with the market cap and the PE ratio, if a lot of time it'll take a couple days for these to update. So if this stock goes up, let's say 10% tomorrow, then this market cap is going to turn into $86 billion, $87 billion. And so it's going to be a little bit different. So that's just something to look out for. Then you have running numbers. So this just means like figuring out, what how much revenue and profits does a company do, and looking at what their TAM is, their total addressable market, and just trying to figure out what kind of numbers could this company be doing in the future. And then finally, we have taxes. The main thing with this is you get to know that long-term taxes means you're holding for over 1 year, and the tax rate on this is going to be less. So you're actually going to save some money if you hold it for over a year, and then short-term is less than a year. So, and that's going to depend on what your tax bracket is, how much money you're making, and all that. Then you have dividends, and dividends, again, it's dividends is normally the tax rate is low. It's normally like 15-20%. But again, it depends on how much money you're making. If you're not making that much money, then you're not going to pay that much in taxes. But that's pretty much it. And so you have all these different resources you can use. You have Yahoo Finance, you have YouTube, you have podcasts, you have Seeking Alpha. And the more information you get from these resources, the better equipped you're going to be to make decisions. And if you feel like this is too much for you to handle, or you don't want to get into this, then just stick with those index funds. And that's one of the safest things you can do, because you don't really need to look at it or check it. You can have it set up automatically where it takes money out of your bank account and just invest into those index funds. So that's all for today, and I will see you in the next video.